Welcome back to Mad About Options. I'm Carla Ye with our Chief Investment Strategist, Judd Pyle, and we're taking a look back at winners and losers in Coca-Cola Company, ticker KO. All right, Judd, KO. 3 C's, but no K. However, the symbol is KO.
Yes.
I was always puzzled by that.
It's a real knockout of a stock. Get it?
All
right, so here's the deal. An October 28th edition of Barron said, if you think the global economic recovery is underway, it could be smart to buy shares of companies with established brands like Coca-Cola. So they talked about a bunch of stocks. We focused on KO.
Okay, great. KO shares are now trading at $54.50. That's down from $56.82 at the time of our original Mad About Options episode. So let's get to the bull case here. How'd they do?
So that original Mad About Options that we did was November 27th. We covered the stock. We said that bullish investors bought the stock for $56.82 and sold the Feb 57.5 calls for $1.60. So just a real plain vanilla buy right. Buy stock, sell calls. You get the dividends that come with the stock. Here's what happened. Investors paid $55.22 because that's the price of the shares minus the premium they collected. Spread expired with the stock at $55.27, so that you didn't get called away because it was below the 57.5 strike, right? 55. So you look at the 55.27 that you paid, all right, minus where the stock is right now. Loser of 77 cents. That's 1.3%. If you had done just the stock, you're out 4% on your money. So we got a little outperformance here, and it demonstrates how a covered call strategy works if you don't get called away. Okay.
Very good. Now, how about the bearish side here?
Well, the interesting thing about the bear side is you say, hey, why is the stock lower? Coke, still, we think, a decent story on the bull side, and here's what's going on. The stock has pulled back recently because on March 1st, they announced that they were going to buy bottling enterprises from CCE, ticker CCE.
Yes, right.
So people have looked at that and they said, well, is there a little bit of dilution here? What's going on? And they basically started selling Coke shares. That's why it pulled back. So I think the bull case is still in motion, but the bears made a little bit of money here. And what's fun to look at here is that we used some leverage. We did 2 Jan 60-55 put spreads, okay? And we paid a total of $6, $3 per spread. Spread expired with the stock at $55.83, which was a winner of $2.34. That's a 39% return versus the stock down $2.32. So if you use this little bit of leverage, okay, you got $2.34 back, whereas if you sold just 1 share of stock, you only made $2.32. But it demonstrates how leverage works. You say 39% return. The question is, though, you only invested $6 rather than investing like 55.
All right. Okay. Thank you. And keep in mind you can check out the premium tab at onn.tv for even more trading ideas. That's all for this episode. Remember, we don't recommend.
We strategize.
On Mad About Options. I'm Carla Ye.
And I'm Judd Pyle.
Wishing you a great trading day. Stay tuned for more strategies right here at onn.tv.